This?
In the airport.
Okay. So welcome everyone. I appreciate you all being on. My name is Todd Wohl. I am the host today with our Capital Markets Lenders Association that our companies, in conjunction with some other of our partners, sponsor and put on educational events, topical events via Zoom, in some cases once in a while live in certain locations throughout the state. And, Capital Markets Lenders Association really was created for one purpose and one purpose only, really to help educate parties that are involved in lending, whether they're asset-based, real estate, specialty lenders, and the professionals that serve the industry, to talk about what's going on at any given moment in time, education events that we like to host and talk about. And I'm honored always to have great professionals to speak. And today's topic, which of course seems to be garnering a lot of interest out there, is, what is happening in the real estate marketplace, and of course, how are workouts being handled. For those of you who don't know me, I am a partner at Braun International and Premier Estates International. We do many, many things. Our companies are well over 100 years old. We cover the US, Caribbean, Mexico, and England are our core markets. We serve and provide lenders with appraisal, consultancy, advisory services, brokerage and auction services for fee simple, for asset-based loans, notes, and a whole host of other things. And today I'm honored to have Michael Crescito from FTI as our speaker, really our expert, I'd like to say, on these topics that we're going to cover today in our 1-hour presentation. As I said, please, if you have a question, unmute yourself or send via chat. This is recorded. It will be on our fiduciaryforum.com website for you to review later. So Michael, if you'd like to introduce yourself and your background, then we'll get started.
Sure. Thanks so much, Todd. Thanks, everyone, for having me today. As Todd said, I co-lead our real estate restructuring practice here at FTI. My background is, prior to going into the consulting world about 5 years ago, I was the global head of workout at Credit Suisse. I was there for more than 2 decades, and so have a lot of experience, being on the principal side and the lender side from a restructuring perspective. FTI, our real estate solutions group, is about 190 people within the broader FTI platform of more than 8,000 employees globally. But within our real estate solution practice, we do everything from, on the front end, doing tax and accounting work, investor reporting, to litigation support, expert witness testimony. We do a lot of business transformation. And then really on the back end, which is what I focus on, is the restructuring part. And we have about 13 dedicated real estate professionals that are deep in the restructuring space. And so, as you can imagine, over the last couple of years, we've been extremely active in restructurings, and primarily office restructurings. So now we're involved in multifamily restructurings, and of course, we've done pretty much every asset class over the years. But that's where the bulk of it has been. So that's my brief background, and I think we probably have 20 some slides here, so we're only on some of these slides we're just gonna spend literally 30 seconds on, just so we can make it through and get to the meat of what I think people really want to hear about, which is what we're actually doing and seeing and how we're trying to resolve situations. So we'll just go to the first slide here. I think this slide really just shows you, over the last year, back in 23 at least, fundraising has really slowed down. Now, what this chart doesn't show is, and I don't have the data on it, but I can tell you that we are seeing much more fundraising now You pretty much see every day a fund saying, or a new fund or existing funds raising capital. I think it was just yesterday that a fund came out and said they raised $1.5 billion just to focus on multifamily in the Sun Belt, and it was oversubscribed. It's pretty much all institutional backing. Having said that, even though fundraising may have kind of slowed down, the dry powder out there is tremendous. And that's what the chart on the other side shows you. There's just tremendous amount of capital just waiting for opportunities, looking for opportunities. And I think, once you start seeing that bid-ask spread kind of narrow down, there's a ton of capital that's going to be deployed. And so we eventually are going to see these transactions really coming forth. I think Todd, we can go to the next one. So this slide is really just showing you that in terms of where funds are being allocated, you're seeing a lot of capital really being deployed and raised for U.S. opportunity. That's over like 80% of it is basically raised in that, and you're seeing a lot of existing funds that have a long-term track record getting more than 50% of that money is coming in there. It's actually over 60% at this point. We go to the next one.
Okay. Capital markets.
Yep. So sales. Okay, so I think everyone knows that there's been very little transactions over the last, let's say 18 months or so, 2 years. We saw 23 transactions plummet, and that's kind of continued into the beginning of 24. However, we are starting to see now some pickup in transactions. They're not, they're still not tremendous, but they are happening. I think CBRE just came out with some stats that investment volume increased 14% in Q2. It's still down year over year. It's 3% down, but that volume is starting to pick up, and we expect that to continue into Q3, Q4. And I'm sure Todd can add some color on this, being involved in that market.
Yeah, I mean, what we're seeing through nationally, I would say, if you see the categories listed on the left here, office, multifamily, retail, industrial, the distinct weakness is office, number one, retail, number two. There is real strength when I compare it, or we compare it to office and retail, in multifamily and even in industrial. Our business, both in valuation, brokerage, and even in certain cases, auction of these types of assets, we are finding still a large disconnect in the appraisals that we're engaged to do for whatever purpose, between parties, I guess I'd like to say, and it is driven, and the purpose is, of course, to determine market value. And if at that market value, appraised market value, does the seller, whoever the sellers are, whatever reason the sellers are selling, are they going to sell at that appraised value? Michael and I were just talking. We just recently got done appraising an office building in the financial district in San Francisco. No surprises that the parties that bought it in 2015 at well over 100 million, the property appraised difficultly in the mid 50s. And the client said, we can't even sell it in the 90s. So, what then happens? I guess that we'll talk about a little later. But there is a large disconnect. In multifamily, we just took on and are taking to market a 75 unit complex that the sellers are hoping to receive about a 4 cap on. Now, we've told them that it'll probably trade for, at best, in the high 5s, probably 6, and the borrowers are borrowing in the mid 7s. So you have a negative yield there on their borrowed funds. Doesn't play very well for the buyer. But depending on the location, the type of property, and I'm speaking about multifamily, there is still some cash. There are cash buyers. To Michael's point, there's a tremendous amount of money out there, but there are buyers who are just sitting on their hands. We work for all types of clients, from big REITs all the way down to, small lenders, and the conversation from each of them, based upon their asset type and what they're dealing with, is quite diverse. We're seeing stress in agriculture, in the agricultural real estate market. We're seeing stress in new construction, in residential. We've got a number of residential developments where we're seeing problems with the developer, the lender, and we're selling a number of new construction deals that are now in receivership. So it's hard to generalize. I think Michael would agree. Every market's different, every asset type. Um, at the at the institutional high end of the institutional end, again, there's so much money, but people are worried about where the market's going to be. I hear it day in and day out. Michael, do you get comments about, where do we see the market in December and in February, after the elections, where rates are going to be?
Yeah, absolutely. I mean, I think the sentiment though has changed, more recently, right? That I think everyone saw, everyone thought last year, oh, 24, we're gonna have rate cuts, throughout the year. Then that became, oh, it won't happen to the second half. Now it's like, okay, maybe next month is probably maybe the first time. And I think that earlier in the year, everyone thought, oh, this is, we're gonna have all these rate cuts, gonna solve all the problems, gonna be able to, values are gonna come back and we'll be able to refinance, et cetera. I think, that's just not reality. And you are seeing some improvement, just with the 10-year, the way rates have changed. It is giving some extra proceeds, and it will help, certainly, but it's not going to just solve the problem overnight. And so I think the sentiment is that you will start seeing some stabilization in cap rates. You may have already seen it in certain asset classes, and you should see some tightening of those cap rates. I think like the next slide that we'll go to, it just gives you just kind of shows you on a historic basis, where spreads were between cap rates and the 10-year, and you see, as of March at least, it was tight on a relative basis, and I think people think that's primarily because you did have a sharp rise in the 10-year, and then property value adjustments just have been lagging, and that's because there's really been very few transactions, and as that kind of unwinds itself, that will probably go back to a more normal spread. But I think we can go on to the next slide, which is really kind of looking at values, right? Because I think if you look at this slide, the obviously office has experienced the steepest declines in value, and by the way, this is all within office, all class from A class to C. So when you actually stratify this and you look at the BC classes, those value deductions have been well over 50%. And I think some of the things that Todd's been looking at on his appraisal side, you're seeing that. I can tell you personally, just things that I've worked on in the B class market in office. I've worked on 2 different Chicago properties. One I think was about a $60 million loan. The best bid and only bid they could get was $5 million. I had a class, probably a former trophy office in Chicago, which is probably an A minus now. That was a $210 million loan, and they only could get a bid of 50. So that just kind of shows you the value destruction that's been taking place in an office. And that's just some, a couple examples. Obviously, I've been involved in some things in Oakland, other parts of the country, and we're seeing it consistently across the board. There's a flight to quality. So if you're in that EC quality class, your valuations are much lower. You'll see apartments here are the next largest, and we'll get into more detail exactly why that's happening. But again, that's overall. So again, as Todd mentioned before, it's very specific to the type of quality you have, the location, et cetera. But I think we're starting to see self-storage issues, and there's other asset classes that are experiencing some declines. And I think that's going to continue for a bit of time here.
Well,
Although when we talk about office, we'll talk about, certain people in the market now think that office may have bottomed. Uh, I think personally it's probably in the trough. I don't know if it's bottomed yet, but it's probably in the trough at this point. Todd, do you have any
yeah, I mean,
thoughts?
I would say, when we talk about office, I think everybody on this call would look at the major markets where you're talking about LA, San Francisco, Manhattan, the Miracle Mile in Chicago, certain markets that are trophy. And I spoke at another conference a few months ago when we talked about obsolescence. And I really can say that the the world of Zoom that we're on, the change in our lifestyle through how we purchase consumable goods, through the likes of any kind of retailer. Um, you know, we're going to see a major change in how real estate exists and who is going to use it and the need for it. And there's going to be a tremendous reduction in overall footprint of certain types of real estate as to it existing in itself. Um, when you get into the secondary and tertiary markets, we just reviewed a property, an office building in outside of Birmingham, Alabama. There's a major bank as a tenant, and the bank is walking away shortly, and the building will be 75% vacant. And the opportunity of getting a tenant in there is probably at maybe 30 or 40% of the rate that they were trying to get. This building is borderline obsolete. And so what happens to what was a $12 million building becomes candidly probably $1.5 million. And what is the use? Is there a use? And we're finding on the buyer side that the buyers are trying to figure out what they're going to do with it and how they're going to make it work. And then, of course, that's affecting the sale price. So I would say obsolescence is the overriding factor in obviously office and retail, and of course how those markets then spread across the other industries that surround those markets that are facing user issues. Then it spreads out. So yes, we're definitely I think in the cusp of a changing real estate landscape moving forward. Okay, Michael, this is your next one to talk about there.
Next one, just very quickly. I mean, I think probably everyone knows that delinquencies are rising, special servicing, assets moving to special servicing are increasing. I think just today, I think office delinquencies, the CMBS office delinquencies exceeded 8% for the first time since 2013. And so, and multi went from, I think, like 2.3 to 2.6%. So that it's continuing. You look on the right-hand side, the special servicing, you just see across the board, it's, pretty much increasing overall with, of course, office, and retail being up at the top and multi increasing significantly as well. I think it's just consistent with what I think everyone's seeing. We can go to the next.
Yeah, I mean, I think the only thing I want to add is, again, just at an event, talking with a bunch of the special servicers and, are they trading? Are they allowing to trade? I mean, there was a lot of no, not at the prices that we're getting. So they're sitting. Some of the regional banks that we're dealing with, they're sitting with assets. We're finding it a little more difficult for them to release a sale at the price that the market's willing to bear. The community banks, interestingly enough, have been we're just starting to see a little bit more of their loans move into special assets, and then trying to figure out how they're going to work them out, and are they going to do work out with the borrower, or are they going to bring it in, hire a receiver, or sell the note? Again, it's case by case, but we're seeing some of the community banks start to pick up in that regard. On to you, Michael, to the next page.
Okay, I'm just keeping track of time. I think this one's really
Yeah.
quick. This one's really just showing that when you look at office, outside of REITs, just NOI is just, declining, and that we think that decline is going to continue for a bit of time here. That's really all that slide is getting at.
Okay.
Office.
So I think we've got to talk about, you want to talk about,
Yeah, let's talk about, we can talk about, office in general, right? Because that's where I've been personally, very active for the last 2 years. And as I mentioned before, it's across, all the markets in New York, Chicago, Phoenix, Dallas, etc. I was just in Seattle yesterday looking at a project, and obviously work from home was, a big impact to office. Obviously, that's I think many people believe that's a structural change. That things will. I don't think there's certain industries there may be 5 days a week again or 4 days, but many other industries, I think people believe that it is going to kind of stay in that 3 day a week in the office, or certain industries just continually be flexible, work from home, maybe come in 1 day a week, etc. So it's going to have an impact, right, on a permanent impact. I think across the board, at least I think the majority of people believe that. There are a few people out there that think it's going to eventually all come back, but I personally don't think so. So that's obviously had a huge impact. What you're seeing is, you take a market like New York, which I think is a really good example. If you look at real A quality, has lots of amenities, where people want to work, where they're excited to go back into the office. That market, that submarket, is doing extremely well. You go away from that, B quality buildings, and vacancy is significant. Values have been very, very, very much impacted, right? And so you're starting to see, even where everyone's talking about the flight to quality, which I think we've seen it directly ourselves. If you can, if you're spending X dollars and now you can now upgrade, you're going to, especially on a more, let's say, institutional type of tenant. I think maybe like private companies that have 10 people, where the real estate really goes into their pockets, by cutting expenses. Maybe they stay in some of those BC buildings, or upgrade within the BC world. But you're going to see that BC quality, as Todd was saying before, is it going to survive? Is there alternative uses for it? I think you've seen people always looking at, can you convert to residential or some mixed use. I think in general, the view is that maybe 15% of the stock is physically able to be converted, and then within that, there's only another certain percent that actually makes economic sense. So you could see many buildings being just scraped. So I think that's what we're seeing. I think Moody's just came out. They think that maybe we're nearing the bottom. Year-over-year transaction volume, beginning in Q4 of 23, it was down 50%. And so now we saw in the beginning of the year some positive movement in dollar volume, and also on a square foot basis of transacting, but it's still at such a low level. They are starting to see, distress sales out there. You're seeing, I think 1740 Broadway was one where I think it was one of the first AAA tranches where those lenders only got 70 cents back in the dollar. So even in you're definitely starting to see some transactions happen, and I think, as I said earlier, those will pick up, and those bid asks will finally start to narrow, and that's really when I think that flood of capital will come into the market. Todd, any other comments you want to make on?
Yeah, I mean, I'm gonna I think the only thing I want to say here is for, some of our viewers, we're talking about A-class trophy office, but I'm going to move into the B's and the C's and the D's, and it's those in office that are going to be under real pressure, especially in secondary, tertiary markets. And what we're finding both in valuation and on sale through sales that we're doing brokerage via or auction, that there is a complete disconnect with the sellers as to where they see the value of their property, even if they have substantial vacancy, and that they're hope on a wing and a prayer that there's going to get some tenants. The new buyer can get tenants and get the building 80% full at 70% of what they are currently rented, the leasable space is rented for. We are seeing some, tenant rep or leasing brokers really trying to support a market on a price per square foot, give some concessions, but I don't think they're aggressive enough, candidly. So these buildings are sitting vacant. I'm kind of talking about the 10, 12 story and lower, 5-story, 4-story office, suburban. It's very, very challenging. So we're having I mean, I guess to the next point on the screen is valuation challenges, right? How are we coming up with, how are we able to use the market data that, of course, as you all know, we have as appraisers have to look in the rearview mirror. We can look at active listings and make a note on that, but USPAP, the Uniform Standards of Professional Appraisal Practice, that we have to follow those guidelines and FIREA guidelines, depending on who we're appraising for and the purpose of the appraisal that is dictated. We have to look in the rearview mirror. I mean, for us, on the sales side, the first thing we look at is what is on the market now. How is it comparing to the actives? And then how long are these actives sitting on the market? What kind of activity is there? And we are definitely seeing, I'm sure like you, Michael, we are seeing properties sitting, and candidly, if we're speaking directly to the borrower, which in many cases we are, their equity is washed away and they're trying to hang on. So, I mean, candidly, for us, in many situations, it is the borrower directly is bringing us into the lender and their lender's counsel to try to work through some sort of process of sale. Unfortunately, we are seeing some lenders that are pushing back on receivers or the cost of a receivership. So we're dealing with that as well. But comps are very challenging, and as you all know, they're very subjective. And so as the appraisal product has to be provided, and what everybody does is look at the front page and say, okay, the appraiser said it's worth 83 million. Well, okay, I guess it's worth 83 million. Right, Michael? They don't read the contents of the appraisal and look at, a lot of the backstory, which is critical to understanding the marketability of the property. Michael, you want to talk about operational costs?
Yeah, I think generally, just to describe kind of what we do and how we get involved in how we look at this to try to help our clients figure out what to do with these assets, is that I'd say, 90% of what I've been doing is representing lenders, right? So as Todd said, they get appraisals initially. We'll help kind of go through that appraisal with them, point out, how it's some of the things that maybe the appraiser was utilizing was backwards looking, right? And so what do we really think? Where would this thing trade today, right? And we basically re-underwrite the deal. We model everything out, and we come up with value. And we say, look, this is where, if you had to go to market today, this is where we think this thing would trade. And based on that, these are the strategies that we can implement to try to maximize value for you. And that could be, we've done everything from taking assets back, where we can demonstrate that with certain investments and with certain projections that we think are realistic, and we have support for those, where that lender may do have a much better recovery. But I'd say in general, none of the cases we've worked on have the banks put receivers in place. I'd say most of them, the sponsor borrower has, I'd say 80% of the time, they're willing just to hand the keys over or work with the lender to sell the asset.
Yeah.
And then there are some cases where the borrower is making it difficult. They're saying, we're not going to hand it back. You have to go through the foreclosure process if you want to get a hold of the assets, and they're looking to do some restructuring. I think lenders in general, up to this point at least, if they don't have to write checks and the sponsor's willing to continue to write checks, they're definitely willing to kind of play ball and roll. If the property requires money and the sponsor's just saying, I'm not going to put another penny in here, then they quickly have us do the analysis to figure out, okay, is it worth putting any more money into this, or should we just go to market, sell it, get what we can, sell our loan, sell the asset, potentially do a DPO with the sponsor. We've done those as well. And so, when we're looking at all that analysis, the TIs and LCs in the market, whatever that market requires, we're modeling that all into the cash flows, right? And so it's important for these lenders to really understand, what is that investment, what's the likelihood that they're going to actually get that money back and a return on it, because from the lender perspective, they can just reallocate those funds into a new loan to get a better return. So we're looking at all that, those types of things when we're involved.
Okay. Go on to the next slide.
I think this is just really showing that growth markets have been outperforming some of the gateway markets when you just look at it. But again, it's so specific to the type of asset you have. These are high level type of slides, right? So I think it's very specific to what type of asset, where it is. I think as an example, you could say, well, Los Angeles. Well, I'm in downtown Los Angeles. Downtown Los Angeles is performing terribly. But if you go to Century City, which is just not far away, they've been performing extremely well. There's the migration from downtown to Century City, and especially law firms, they've really expanded into Century City, either moving a big majority or actually just leaving downtown. So you really have to look, even within one city itself, you have to understand those submarkets.
Yeah, I think the only thing I want to add there is that for the smaller firms or more regional firms that are trying to reduce, well, I like to say put more money in the partners' pockets, and I'm not talking about just legal, could be business center, professional business services, and so on. We've had a number of clients have gone out and bought their own buildings, and between the benefit of acquisition, ownership, depreciation, asset money going into an asset, hopefully that's going to increase in value or at a minimum be stable, than pouring it into a landlord's pocket. We're seeing quite a bit of that. But yes, I think from market to market, it is very different in Southern California. I mean, it's the same in the Bay Area. You go into San Jose versus the city, being the city of San Francisco, versus even downtown Oakland. Each of those markets are acting very, very differently. Michael, to the next one for you.
I mean, this slide is really just showing you that the return to work impact, right? It's just, financial and professional services, they are definitely making a push to get their employees back. If you look in New York, for instance, the big banks have mandated people come back 5 days a week. So you're seeing that. I'd say in general, it's away from financial institutions. Law firms are trying to get their people back in, but I don't think they're back in as much as some of the banks have been. And then when you go away from those industries, it drops down a lot. In fact, I think you're seeing, I saw an article recently that said, just trying to, even though they have mandates to come back 3 days a week in certain industries, they haven't really enforced it that much because they're just concerned about employees jumping ship to other companies that are providing more flexibility. I think as the economy, there's a thought process that the economy deteriorates further, and that will take power out of the hands of the employees, and therefore you may see an improved return to work. That hasn't really happened. I think it's still hovering around between that 50-60%, depending on which industry you're in general. And so I think that's why I was saying before, I personally believe this is a fundamental shift in office. And so that's what this slide is showing.
Right. We went into multifamily, but let's talk about the loans itself. I'll let you start off, Michael.
Okay, so I mean, again, I've been pretty active in the multifamily sector, and again on the lender side. I think generally the issue with multi, it's always been a great asset class, right? It's just more recently that you're starting to see the stress in it, and that's for a number of reasons. One, on the revenue side, rents on these things were underwritten a few years ago. It's the hockey stick approach to rent growth. Depending on what market you're in, we've actually seen rent growth. It may still be positive, but nowhere near as much as projected, or in fact, it's flat or going down in certain markets, especially in Sun Belt, where there's been that tremendous migration, but there's also been tremendous supply coming out, and so there's an imbalance right now. So in the Sun Belt, as an example, rents have actually come down. Yeah. So when you have on the revenue side, and then when you look at the expense side, insurance costs have gone through the roof, labor costs, taxes, just construction costs, if there's renovations going on. So the combination of that with your NOI being depressed, then you overlay that with maturities coming up. Many of these multifamily loans have been syndicated, so they're not really deep-pocketed sponsors. The lenders, although the lending market is still wide open for multifamily, it has tightened a bit in the sense of underwriting standards. So maybe LTVs are a little tighter, maybe debt service coverage ratios are a little tighter. There's plenty of capital there, but when you kind of take that combination of it all, it's causing distress, and that's what we're seeing. We're involved in a number of these things. I think if you look at my personal view on multi is, I think it's still a very solid asset class. I think those imbalances are going to work themselves out over the next, call it 2 years or so, depending on specifically which market. There's still shortage of housing in the United States. So I think I believe it's still going to be a very strong asset class. I think it's a good investment. And I think the ones that I'm personally involved with, they're more specific, asset specific in terms of, poor management, cost overruns on renovations, just natural disasters. One I'm working on has 2 fires and it's taken units offline, and it's messed up their business plan. But as a general matter, I think unfortunately you are going to see more stress in it. So there's going to be more workouts to deal with. But I think this is an asset where lenders may be willing to put money into these and hold on to them to maximize value. So that's kind of my overview of this stress multi. Todd, you want to talk about?
Yeah, I mean, I'll talk about a few things quickly. I mean, what we're seeing in multi is, for those of you who are in California, California is one of the states that has become a landlord's nightmare. Candidly, depending on what county that the asset's located in. San Francisco County, Los Angeles County are 2 examples of where there have been in Los Angeles County a month ago, a month and a half, 2 months ago, LA County put a cap on rent increase to 65% of the CPI moving forward. The city of San Francisco is probably one of the worst places to own multifamily in the country. Their tenants' rights laws are so onerous that I have clients, we've just sold numerous multifamily projects, properties in some A locations. And I am seeing and hearing from the owners and the buyers. Buyers are definitely concerned about the pro forma numbers that they're putting forward. We just had a deal that almost fell apart because the lender said the pro forma numbers for the and the time that the buyer was going to believe they could get the existing tenants out. Most of the tenants have been in this property for a period at a minimum of 10 years, some 20 years. So you can imagine how under market their rents were. And as we like to say, cash for keys doesn't always work. So the lender changed their LTV on the loan and tried, almost blew the deal up. And we were able to negotiate with the seller and the buyer and get some more cash put in and get the lender to be able to underwrite the deal. So we're seeing real pressure in the California major markets regarding rent, the opportunity for rental increase, and how they can get tenants out that have been in there. Those of you familiar with the Ellis Act, which allows a redevelopment of a property, that the Ellis Act has come in with tremendous power. And now the cities are becoming very sensitive to this and worried that there's a lot of phony Ellis Act conversion going on. I'm no expert in that other than to say that the first question is, from a buyer, how do I get the tenants out of there? That's the first question. So we are seeing cap rates increase, but the sellers are some are still in fantasy land. The other thing that I would highlight that Michael probably said, kind of cursory, which is insurance. We just had a large multifamily project sale that was almost $30 million that when they went out to get new insurance, and this was in what's called the red fire zone for those of you in California, the only the only insurer out there is Cal Fund. So the mainline insurers are off the table. The insurance went from $43,000, Michael, to $238,000 annually. So what ended up happening? This was a lender deal. They had to reduce their sale price to get the deal done because the NOI went down pro forma wise almost $150,000. So
I hear you. I just experienced this last week. I'm working on a Jacksonville multifamily deal. We negotiated a DPO. It was a $37 million loan. And we were doing, my client, the lender, was going to take 34. They had a refinancing lined up. They had the owner borrower was projecting an increase from, I think, 600,000 to 900,000 on the insurance, and the insurance came in at 1.6 million, blew up the deal.
I mean, so to your point, Michael, the sellers and the lenders and counsel, they are not thinking about the cost of insurance. It is, to us, the number one thing that we're looking at when we try to pencil a deal now for whatever purposes. And even in the appraisal, we're noting the cost of insurance and that unknown factor. And by the way, we are now seeing from a few very tough lenders that Cal Fund, as an example, in California, the same issues are in Florida, right? Hurricane Alley, that their insurance coverage is it's so much less than what you would get from the mainline insurers. So, the lenders are very concerned and are putting in to their loan agreements, what kind of insurance and how, the borrower is going to have certain liability there. Again, these are things that are, 2 years ago, 3 years ago, we didn't have to deal with. So again, very market specific issues, of course. But yes, I would agree with Michael. Overall, multifamily is a very strong asset class. And, I like to say the rats and mice buyers out there, and that's all relative to a given market. The rats and mice buyers out there, the first thing they do when they look at a real estate investment, they look at multifamily. So lots of money that goes to it. It's just a question of the overall. I guess due to time, let's go on to the next one. Michael, you want to talk about supply? Anything here?
I mean, again, I think it's just more as I said before, you're just seeing certain markets more, I'd say primarily Sun Belt, where there's been a lot of new supply. And that is what's, directly impacting those rental rates. There's decline. And again, it's going to take a couple of years for it to work itself out. But I think in the Sun Belt, I think that migration is going to continue. There's going to be continued demand, once that supply is picked up. And on a longer term basis, I think that it's still going to be a very good market. And again, on the coasts, there's shortage of housing on the coasts, and I think that's going to continue.
One thing I'd like to add, I mean, this isn't that relevant to all of you because most of you are on the distress side, but we are now seeing in, again, California, the affordable housing issue, and the city of San Francisco, the city of Los Angeles, providing vouchers for affordable housing. And, there is a high degree of conversion because, real estate is an entrepreneurial business, and, the buyers out there are looking at properties that were just strictly multifamily overall and trying to convert to affordable housing or build to affordable housing criteria. We have a client right now that's got the rights to put in about 2,100 units in the city of Los Angeles. This is a very, very large deal. And I will tell you, and this is a conversation I had just last week, that the average 1 bedroom, 1 bath voucher is $3,200 a month from the city of LA. If you ask me what the average rent for 1 bed, 1 bath in the city of LA is, I'd probably tell you $2,000. So you can see the disparity there. So there's going to be a tremendous conversion, which will then, to Michael's point, limit standard multifamily. That is going to be a sea change. And the state of California has mandated, affordable housing, and each city to have affordable housing. So it's affecting, I mean, I guess in some ways positively, because if the property is now converted to a portion of affordable housing, well, then the NOI goes up. But you got the cost to do it, and the lenders, are they willing to front that cost for conversion? Anyway, just another sub note there. Michael?
I think this is kind of in line with what we talked about before. We're depending on the market, rents are in general, they're flat. I think a report I just saw the other day saying that they're relatively flat. Occupancy is, I think, overall, is vacancies on like 5.8%. It's expected to come down to 5%, in line with historicals over the next year as a general matter. And then, of course, in a sub market, it's going to be different. But in general, rents remain flat overall.
Okay. Well, hospitality, we could talk a lot about that. Michael, go ahead.
I mean, I think hospitality, in general, of course, there's still distress there, but in general, it's been performing well, right? There's if you look at some of these stats here, post-pandemic, consumers are spending, now more on transport and travel than they had before. You're seeing, younger generations still traveling a lot. If you look at all the resorts, the higher end resorts, the rates outrageous, and they're getting them. It's going to be very specific, to an asset why it's distressed. But as a general matter, I think, hospitality has been performing well.
Yeah, I mean, the only thing I'd say here in deference to time is the lower tier market, the $20 million and under asset class that could be much older 60s, 70s product, exterior corridor product. We've got a number that we're looking at right now. Actually, interestingly enough, a almost a brand new property in Sri Lanka that is their occupancy is at 50%. They've just changed their flag to NH. And the developers got into the hospitality business on a whim, not really knowing what they're doing. And I suspect by the time we're done, if we decide to take this sale on, that they're going to lose probably 30% of their overall investment. They put in 75 million. It'll probably trade for 45 million. Yeah, I mean, again, it's asset specific, location specific. But the older assets are under more pressure because the licensing companies and the franchisors are becoming more stringent on the PIP programs and improvements. And if you've got a tired old building, there's not much you can do with it.
I think that's right. I think that's where you probably see distress, is that
Correct.
where you had, especially with COVID, the brands didn't really, push the owners to spend the money. But that's, obviously now we're well beyond the pandemic, and you are seeing them now enforce those PIPs. And so there's certain owners that may not have the capital to do so.
Right.
That will cause some distress. Or there's, depending on what the asset is, it may not be an attractive asset even by spending that money, and those owners may decide, it's not worth them putting additional capital in.
So on our last slide, resolution strategies that we're seeing employed. Michael, you want to start off? Got a few minutes?
Yeah, absolutely. So, I mean, I'm pretty much seeing almost all of these on this page, depending on the situation. And just to give you some background, I've been involved in everything from, just bilaterals, single assets, to portfolios that are bilateral or syndicated small groups or securitizations. So these things are being implemented depending on the situation. So we've been involved where, New York City office building, where, the sponsor in that case is not willing to hand back the keys and has forced the lenders to, file a foreclosure, which we did, just to put pressure on the sponsor. But at the same time, we're negotiating with them. And in that case, we're working on a deal where we are doing a AV type structure, where they'll be coming up with new capital. The lenders are going to basically resize their first lien to a certain level. The sponsor comes with new capital. In fact, the lenders may even come in with some prime themselves just for the construction costs in conjunction with the sponsor. And so we're seeing creative structures depending on the situation. So that's something that we're seeing. We have been actually talking to a number of there's a bunch of funds out there that have capital available to fund TIs and LCs when either the sponsor doesn't want to do it or can't do it, or the lenders may be interested in taking the asset back but maybe not putting the new money in. And they'll cut deals with these new funds where they'll put in new money and they'll have a sharing arrangement on exit. On that new money will want to get paid, obviously, interest on that money during the period, but their big return is at the end when they exit. So we're seeing that. As I mentioned, BPOs. I've done a couple of BPOs already. Everything from some, let's say, suburban Class B office to some multifamily, et cetera. So that's going on. Todd, I mean, short sales, I've seen that as well, where basically what happens is sponsors not willing to put money in, lenders don't want to own it and put any more money in. They agree with the sponsor. Let's just go to market and sell it. And, we'll take what the market says and they'll satisfy their debt that way. So we're seeing that as well. I think you mentioned, Todd, the tenant JV, where sometimes the tenant will either JV with the lender in terms of taking it back, where let's say they're the majority tenant, and they'll want to say they'll take ownership of the building with the lender, put some capital into it that way, or they'll actually buy the building outright from the existing sponsor, because they, from an economic standpoint, buying the building at that low basis, and they may have expansion plans, et cetera, that it makes economic sense. The reuse conversions, that we've had a lot of discussions about, but in the deals that I've personally been involved in the last few years, we have not seen those conversions, actually happen, and that's specific to those buildings, just because even though there may be a use, just the economics wouldn't make sense. Foreclosures, again, yes, those are, lenders are, when they decide that they do want the asset, but the sponsors, not willing just to hand the keys over, they are willing to go through that process, depending on which state it is. We were prepared, in fact, on a portfolio of assets where we were going to go down that foreclosure route, because the states that they were in, there were 4 different states. It was a 30 to 60 day process. And so it was relatively fast to do that. If you go in, California or New York, certain states like that, where it can take quite a bit of time. The lenders have to really think through that, especially if they have to carry the property, or they don't want the sponsor necessarily being in place. So there's a lot of complications with that. And note sales, we've helped our clients work through note sales, giving them valuation and kind of where we think execution would be.
Yeah, let me just chime in there real quick. What we're seeing on some of these, just on because this is a common question, note sales, I'm generalizing, but a note sale might come in at 15 to 20% a greater discount than if we were to sell the fee simple. So we always try to push the parties to sell the fee and not the note. It depends on the asset. But note sales are definitely underperforming fees, the fee sale. Some lenders are hell-bent on not hiring brokers or an auction company to sell the note, to sell the fee, because they got all these people calling them, and we'll just sell it internally and save the 1 or 2% or whatever it is, but they never get the exposure. They never get the exposure that the market can provide. I will tell you, in all of our auctions, for those of you who use auctions, we are not compensated by the seller, we're compensated by the buyer. So the seller has a net, call it zero cost for the transaction. But we are trying our best to run fee simple sales and not note sales. Foreclosure sales obviously are required. That's candidly a more cost-effective approach, at least from a time standpoint, versus a note sale versus a fee simple sale. Does anybody have any questions? I know we're at the top of the hour. If you want to unmute your mic, please do, and you could just ask a question real quickly. Also, we're happy to distribute this presentation to you. You can just send us an email and we'll send it over to you. This video will be available for reviewing on our Fiduciary Forum website, fiduciaryforum.com as well. I don't see anybody that has any questions. I guess all I can say is, Michael, thank you very much for taking your time to present and to prepare and show us your expertise and talk to everybody. I can't say it enough, and I've been honored to know Michael for quite a while and work with FTI over many, many years. So I can't say enough about them and his organization. So thank you, everybody.
Thanks so much for having me, and I appreciate everyone's time. If anyone has any questions, of course, reach out to Todd or myself. We're happy to answer. Want to talk about any assets specifically?
Yes.
Give you our views or thoughts on them.
So everybody, thank you very much. We'll end the presentation today, and we'll look forward to seeing you at our next CMLA event. Thank you all very much.
Take care, bye.
Bye-bye.